Do you want to retire a millionaire? Simple. Save $525 a month from age 30 to 60 at an assumed 10% return. That's it. Math says you're golden. So why don't most people do it? Because money isn't a math problem. It's an emotional one. You get a bonus or a tax refund. You know you should invest it, pay off a credit card, save it, but what do? You buy something that you've wanted for years. That's not poor math. That's very human and a very emotional decision. Today, I'm going to show you why success with money isn't about equations or spreadsheets. It's about emotion, behavior, and psychology. And when you will finally stop trying to be a robot and start acting like a human with a plan, you will win with money. So let's go.
Welcome to the Financial Mirror. Where future success is reflected in our knowledge of fixing the one thing we can control, ourselves.
Welcome to the Financial Mirror, and thanks for joining me today as we continue to work to improve the one thing that we can control, ourselves. Here at the Financial Mirror, it is not about the numbers and spreadsheets alone, but about transforming and educating you on money so that you can make smarter financial decisions. If this is the first time you're joining in, don't forget to hit subscribe on YouTube to be notified of all the new episodes as they release. If you're listening to this on Rumble, don't forget to follow the channel and like the video. And on any podcast platform of your choice, don't forget to like and subscribe to the podcast. So in a previous episode that I did, and it's been about a year ago now, I did an episode and it was called Paying Off Your Mortgage Beats Investing. And it wasn't totally about math. Some of it was, and I'll be honest with you, it's not as clear as you think. Many people think that you should just invest, and never worry about paying off your house early. But there's a little bit of math in there that may sway you in either way. But it was not all about math. It really wasn't. And it was more about peace of mind, security, and more importantly, motivation. But the comment section lit up, and I pulled up a few of them just so I could show you. But here's one of them. You know, it all comes down to math. ROI versus interest on mortgage. Next one was sounds like a sermon, not a rational discussion, since the math is the math. Next one is, primary message here is ignore the math. Bad advice. If you aren't emotional, it makes mathematical sense, right? Like all these things are about math. Terrible advice. Your only counter is based on emotion, and you're not someone I'd turn to for financial guidance. And one of the more recent ones, paying off a home before saving and investing is a personal choice. Only one choice is mathematically logical, right? Everyone talked about math. That's what everybody threw. So people threw out all their feedback, and a lot of people that had negative emotions to that episode talked about math. And in most cases, the folks that gave examples of where they were coming from, mathematically, they weren't wrong, right? In most cases, not all though. Some of them are really bad, but in most cases, they weren't wrong mathematically, but that's the point. Most people live their financial lives trying to optimize it like a spreadsheet, and then they beat themselves up when they don't, right? They really start to hit on themselves to say like, man, like I'm just not getting it. I'm not good with money. And realistically, it may not be you. Well, I'll take that back. It is you. It's not the math, right? That is the thing. That's the thing that we're going here. So today's conversation is going deeper. I'm talking to you more beyond math and into a mindset that can help you win with money. Because I'll be honest, money's not hard. Being successful with money is not hard. I'm not saying that you're the next Elon Musk and you're going to be worth, $1 trillion, right? That's not what I'm saying. What I'm saying is that winning with money, being financially successful, is not hard. The problem is this math fallacy, right? We think we're logical. Like we as a human being, we think we're logical. So we solve these problems or try to solve these problems with math, and it doesn't work. So let's play with the numbers. I'm going to head over here to my favorite compound interest calculator over at investor.gov. And I use this for pretty much every episode that I ever talk about with compound interest. But let's just say, for an example, you invest, you'll start with zero, and you invest $50 a month for 50 years at a, let's say, 10% rate. And let's compound that annually, right? So let's make sure we're getting 10% over the entirety of the year. And you would land in 50 years, you would land with $698,000. That's powerful. Like, that's good. Like, you took $50 a month, which you could literally cut out eating one dinner out, and you'd probably have your $50 and invest it for 50 years. And you're almost at $750,000 with just that, right? That's long-term discipline, and you're winning, right? You're winning. $50 is easy to invest over time. Easy. One dinner, you've invested it. Now, let's flip it. Let's say that you invest that same $50 a month, and let's say you do it for the first, let's say 10 years. That would have landed you $50 a month over 10 years, and you'd be sitting at this $9,500. So now we're going to take that, and I'm going to put that in my initial investment, and now I'm going to do zero contribution. So what I'm doing here is that if you took $50 a month, invested for 10 years, and then you just stopped investing, what would it be, right? Because after 10, you'd have the $9,500. Then you're going to do a $0 contribution over the next 40 years. What would it grow to? Well, you're sitting at $432,000. So you literally took 10 years of your life, you invested $50 a month for those 10 years, and then you let it ride for 40 and didn't put another dime in it. You're almost at $500,000, right? Not quite to, half of there, but you're pretty close, right? Give a few years where you didn't get 10% and maybe you got 15 or 20, like post-COVID era, like you're probably at $500,000, right? Just saying. So you did nothing. You did it for 10 years. You invested $50 and then you let it ride. So let's just say you did it and like you were super gung-ho and you're ready to go and you were graduating college and you were like, yep, I'm doing this thing, and $50, and then you let it roll, right? You turn 68, you got $500,000 almost. So that's compounding magic. And it is a math problem. Like what I just did is a math problem. But here's the issue. I just showed you two examples. One, kind of the long-term discipline plan, and you walk away with almost $750,000. And I showed you this other way that's kind of lackadaisical investing, and you still walk away with almost $500,000. But the problem is that that's the issue, is that you know this. Like I just showed it to you, and it doesn't mean that you're going to start doing it. It doesn't mean that you're going to cut off this episode and go and automate your savings to where you're investing $50 a month. It's not. It's not convincing enough. It never will be, because we're not calculators. Human beings are not calculators. We are creatures of desire, fear, envy, and comparison. And comparison is what's killing most. But math doesn't move us. Math doesn't move us. So when we look at those comments, you have to wonder, why is it that if I can show you all these math problems, if I can show you how easy it is to be a millionaire, if I can show you how easy it is to win with money, why do more people not do it? Well, it's because math doesn't move us. The results of that doesn't move us. Emotion does. So the real enemy here, the real enemy in you being successful with money or not, is emotional spending. So let's talk about that. Let's talk about the bonus that you got, or maybe the tax refund or some surprise inheritance. And when you receive it, that windfall hits you, you tell yourself, I should invest this. I should invest this. But then life happens. You think about that vacation you put off. You think about those shoes you didn't buy. You think about the furniture you said you needed to replace. In that moment, it's not a logical decision. It's an emotional release. It's finally being able to tell yourself yes to something that month after month after month, you had to hear no. You had to hear yourself tell yourself, no, you can't have those shoes. You can't go on that vacation. You can't replace that furniture. Every month you told yourself no, and now you've got it. Now you've got the money. Here's your time to say yes. Emotion kicks in. You get that emotional release and you tell yourself yes. You don't spend because it's smart. You spend because it feels good. It validates something deeper, whether it's self-worth or accomplishment or control. And the more powerful one that I'm seeing more times than not is like deprivation, right? Folks that grew up with nothing, they've earned their way to a good living, and now they're trying to fill that void with stuff. They were deprived throughout their whole like adolescence, and now they're filling their life with stuff. So if we don't learn how to recognize the emotional triggers, we will never really gain control over our money, right? So the myth of smart financial decisions is people say, do what makes sense financially. Do what makes sense financially. And it's a myth. It's truly a myth because that sounds really good, right? Like it makes perfect sense. Mathematically, it makes perfect sense, right? Like that is what everyone tells you is, hey, it makes perfect sense. And all of a sudden, it doesn't, right? It doesn't. It is an emotion that kicks in, and all of a sudden you're like, wow, you try budgeting and you get the app and you read the blogs and you watch the videos and you listen to episodes like this, but it's not sticking. And you're like, why? Why? Because you haven't built an emotional alignment with your money. You're trying to go diet with math while living in this like fast food world, right? Like you're trying to lose weight, but you're not tracking anything about it. You're not making decisions that will help you lose weight, right? Like losing weight, and I'm not here to talk about, your health and wellness, but like ask anyone just the standard equation for losing weight, and it's burn more calories than you intake, right? Expend more than you intake. And I could say the same goes for money. You will win with money if you spend less than you make, right? Yeah, sure, there's nuances to all that, but in its concept, in its basic concept, if you will burn more calories than you bring in, if you will spend, less money than you're bringing in, you will have a better outcome, right? In the most simplistic form, you will have a better outcome. But why do people not stick to it? Well, because smart isn't sustainable unless it feels safe, motivating, and realistic. And for a lot of people, it doesn't feel realistic. This whole chart, and I can throw anything up here, and I could say, you know what? You start with zero and you invest $525 a month. You do that for 30 years, 10%. Look at that. You're a millionaire. 30 years at $525 a month and you're a millionaire. Right? That's not motivating because for many people, $525 a month doesn't feel realistic. And for even more people, doing that for 30 years, right? That's really the killer. That's when people really lose sight. So instead of chasing the most financially efficient move, right? Ask, what is the decision I can live with? And what decisions motivate me to keep going? Because that's really all that matters. It's finding out not can I contribute $525 a month, but what can I contribute to do it for 30 years? And that's the question. That's the question that'll move you from what feels impossible to finally get a way that will stick so that you can be successful. Because remember, I said, smart spending, smart investing, smart money isn't sustainable unless it feels safe, motivating, and realistic. So we've got to make this plan realistic. So what can I do for 30 years? Can I do $525 a month for 30 years? Maybe one day, but maybe not right now. What if right now it's 125, right? What if it's right now, like all I can get away with is 125? But let's say you do that for 10 years. For 10 of those 30, you do 125. Well, you're sitting at 23,000. So I'm going to move that up to my initial investment. And maybe for the next 10 years, I got a raise. I got a little money, extra money coming in. Maybe I can bump that to 200 for the next 10 years. What am I sitting at now? Wow. I'm at 100,000 and I still got 10 years to go, right? I still got 10 years to go. So let's move that 100,000 up here. And let's say, man, I really hit a home run finally in my later years, my good earning years. And I can do 350 now, 350 for those last 10 years, same 10%, boom. Doing all right, right? I'm doing all right. So, it's more about what can I do right now instead of always saying what does it need to look like forever, right? Like what can I do right now? That's all that matters. That's all that matters. So here's the thing. I want to give you three things that can help you start to make emotions work for you. Three things. The first thing is accept that money is emotional. Stop trying to tell yourself that it needs to be the perfect math equation. Realize that money is emotional. Guilt and shame will only grow when you pretend otherwise. Stop telling yourself that money will be solved with a math problem. It's not. It's not. At least initially. And I'm going to get to that in a second. But initially, it's not. So tell yourself, hey, accept it. Money's emotional. And I've got to do something that I can do for the long haul because life will happen. So that's number one. Step two is you need to build emotional rewards into your plan. Instead of just saving for retirement, you need to reframe it. You need to say, hey, I'm buying freedom in my future, right? I'm putting this money away because I hate my job and I don't want to work it anymore, right? Give yourself a reason to do it. Not just like, oh, man, I just saving for retirement, if that day ever comes, that's not very motivating. Reframe it into something that motivates you. And then the third step is automate all the boring parts of money, right? Remove the daily decision making, set up those auto savings, do auto investments. You will start to win by default because these things will just happen, right? When you combine some automation with emotion, you stop fighting yourself and you stop needing willpower. You just let the system work and you will start to build good habits. Now, that's when I tell people that once you get there to where you have good financial habits, sure. Can math make building wealth more efficient? Yes. Yes, it can. It absolutely can. I'm not going to sit here and tell you that there's not a more efficient way to put money in certain areas and invest in certain places and, have certain strategies around paying off your home versus investing. I'm not here to tell you that. What I'm here to tell you is that once you get to the point where you're winning with money, once you get to the point that you've accepted it's emotional, once you get to the point that you've automated a lot of it, you've built some good financial habits, yes, bring math back into the equation, but you're much more likely to stick to it because of the fact that you know that long-term plan is realistic. You know that long-term plan is safe and it is motivating, right? So that's what you want to get after. So if I tell you to save $500 a month, it sounds like a sacrifice. But if I say save $500 a month so you never work a job you hate again, it just hits different, right? It hits different. It gives you a little more something that makes you want to go after it. So that's the power of emotional framing. So if you want to stop the emotional spending, if you want to create those emotional anchors to your goals, you've got to use something. You've got to build a plan. And it could be something as simple as the compound interest calculator. It could be something as simple as just saying, hey, here's my goal by the time I'm 40. Here's my goal by the time I'm 50. Break it up into 10-year chunks. It's totally worth it. So I gave you that example and I'll pull it back up here, but if you took the $525 a month for 30 years at a 10% rate of return. I'm going to throw it back up here. If you took this at 30 years, and you're 30 when you start it, right? So in 30 years, you're 60. Let's say that you want to retire a millionaire, and you at 30 you had an opportunity to do 525 and you didn't. And you waited because you tried every math problem, every app, every spreadsheet, every person's opinion, and you held off and you did nothing, right? Trying to find that perfect plan, you did nothing. Well, I'm here to tell you that now that you're 40 and you still want to retire at 60, that 525 is now going to land you $360,000. So you'd have to bump that up to, let's say, what about $1,250 maybe? $1,250 will get you to $859. So this is looking dangerous. $1,500 might get you there. Yeah, $1,500. So it's going to take you $1,500 now a month to hit that millionaire because you waited, because you did nothing. You had an opportunity to do 525 and now you're not. Now you're doing $1,500 for the next 20 years. But you decide, that's too much. And now you're 50 and you got 10 years to go. Even that $1,500 now is going to land you at $286,000. That puppy right there is going to be closer to about $4,000. Oof, $4,000 is not even enough. That puppy's $5,000. Oh goodness. Look at that. Yeah. $5,000, maybe $5,250, $5,500, something like that. Let's try $5,250. Yeah. $5,250 a month in 10 years will make you a millionaire. I'm just saying, we're not losing years. You're losing how easy is it going to be. The longer you wait, the harder the math has to work. So time matters, but emotion controls the clock. Determine how many years do you got? How many years do you got left before you retire? If you want to know what it feels like to be a millionaire, if you want to know what that feels like, I'm here to tell you it's in your grasp, but waiting is the worst thing you can do. Waiting is the worst thing to do because money isn't about doing the perfect thing. It's about doing something and doing it consistently, right? Doing the emotional thing that works consistently, right? And if you can do that for 30 years, 40 years if you've got it, right? 40 years makes it even easier. But if you can do that, remember, you will be successful with money. Be consistent. Realize that it's not all about a math problem. It's not all about a math problem. There's emotion in money, lots of it. And just know that if you will stick to your guns and do what's right and just live a little, right? Live a little, but realize that you're fighting yourself when it comes to being successful with money. When you realize all that and you put it behind you, you'll be successful. So hopefully this made you think differently. If it did, subscribe to the channel. Leave a comment below. What's the one emotional decision you've made with money that you're thinking through now? Like, man, I better understand that, and I wish I would have done this. What is that? Because remember, the path to wealth starts with you, not a calculator. It starts with you and your decisions, not a calculator. I can throw tons of equations at you, and you can do nothing, and you will end up with nothing. I can throw a plan at you, and you're in debt. That plan will get you out of debt. You don't stick to it, you'll still be in debt. I could throw a plan at you and say, you can retire a millionaire. You do the plan, you retire a millionaire. You don't do the plan, you don't retire a millionaire. You see how this is all emotional? You choose if you're going to do the plan or not, but it is on you as an individual, and that's why personal finance is always personal. So thanks for tuning in. Hopefully you got something out of this episode, and if you did, like I said, subscribe to the channel, leave a comment below, and till next week, continue improving the one thing you can control, yourself. Peace.
Well, that wraps up today's Financial Mirror. Join us next week as we continue to work on ourselves, change our mentality, and to commit to achieving the success we always envisioned. Regardless of your platform, Help us grow as a community. Please like, subscribe, and share with the people in your lives.